Okay, this is the third in our series on Chapter 7, excuse me, in our budgeting class. We've been talking about capital expenditures and budgeting for those, and how some people have a separate budget, some people don't, how that budgeting process works, and how it's a little bit different from our budgeting for our operating expenses. Want to talk just a little bit about some of the problems in capital budgeting. First of all, um, we talked about in the last video, we talked about the process that you have to go through for planning of, appraisal, reappraisal. And that's one of the problems with capital budgeting is you have to redo that every year. It's not something that it's once and done kind of a thing. So every year you have to reassess and reevaluate and prioritize your needs as it comes to the capital projects and capital improvements. It may be that things have happened within that year's time that have shifted a focus from one project to another, or from one, something in the economy, something that's happening in the world. Think about as 9/11 and the changes that brought about, and a lot of capital expenditures that had to be, or the money that was spent on infrastructure and things like that. So it's not just you get one done and mark it off and go to the next one. You have to reevaluate every year. So it's not a question of time. It's not like the oldest project or the oldest piece of equipment gets replaced. It has to be based upon the needs of the climate, politically, environmentally, all these other things that affect into the services that are provided. Certainly the availability of funds is a problem. When we're talking about capital expenditures, we're talking about big ticket items, and this costs a lot of money. And so do we have the money for this? And if not, where are we going to get them? Some projects may have earmarked funds. If you think about your SPLOST money, and I know I can't remember if I mentioned this earlier or not, but a lot of communities are getting SPLOST money, the special local option sales tax. And that money is earmarked, whether it's for public safety or whether it's for parks and recreation. But a lot of communities do get SPLOST dollars, that's earmarked money, and that's okay because it's that money's there. But in certain situations, there's no money. And that is certainly one of the problems when we're talking about capital budgeting, is where can we find the money for this? It can, something else that capital budgeting, I guess, or budgets can do, it increases the desire to create a debt financing. Think about your own situation, your own personal situation. When we need a big ticket item, whether it's a new car or, the refrigerator breaks or the air conditioner needs replacing, where we have this tendency to go into debt to do it. Well, the government's no different. And so when we have all these big ticket items, these capital expenditures, it increases the desire for debt funding. And remember, that just pushes it into the future, and that may not be what we want to do. So you really have to be careful with that whole process of it. And then establishing priorities. And that's just again, that's more than simply it's standard in all public decisions, is who gets the money? What items go into the capital budget? There's always a bargaining mechanism. Sometimes the chief executive may have some thoughts about that, of what that individual wants to see or what their priorities are. But it is always, it's how you justify it, your justifications, if you want to put something in the capital budget and show how it can be paid for, that's the whole concept, I think. It's not saying, hey, I need this, I need you to pay for it. But you have to offer up solutions on where the money can come from and how it can be paid. When we're looking at capital expenditures, there's a concept called accounting for time, I guess is what your book calls it, discounting and compounding. These are very much accounting terms. If you have taken accounting 1 and 2, this makes more sense to you. I keep saying that I'm going to do that. Some of you have had Mrs. Goss for a business class or 2, and I keep saying, and this may lead me to do this, is to sit in on her accounting classes so that I can gain the knowledge that I need to grasp these concepts. But it's discounting and compounding are the building blocks of financial analysis. As we project to the future, operating budgets, as we've said earlier, look at 1 year most of the time. There's some communities where it's 2 years, but most of the time it's 1 year. And but capital budgets may look down the road of how many years is it going to take to pay for this particular project. So there's a lot of forecasting that goes on. There's a lot of accounting, financial analysis that has to take place. And it has to do with the value of the dollar today. Not so much the value, well, yeah, the value of the dollar today and the value of the dollar in the future. And so it helps us to be better budget planners by using those terms. I'm not going to get off into those because I can't explain it. This is one of those times when I think being in a classroom would be really helpful because you could draw on the board. And I have included in the content section of the course for Chapter 7 some pages that I copied from the accounting textbook that is used here at the college. Those terms and that book is, remember, it is based on private sector. They're talking about making money. And in the government, we're never talking about making money. We're not here to make a profit. And so you have to keep that in mind, but it may help you understand some of the terms that this particular book uses when it comes to talking about discounting and compounding. I think I understand the process of compounding better than I do the process of discounting, which is just basically compounding in the reverse. But to be able to explain it as a concept, it has to do with, if somebody gives you $1,000 today, or do you want $1,000 down the road, and what you're losing, I guess, by not getting the money today, or what you're gaining by getting the money today. When we're talking about compounding, I compare it to your basic savings account in the bank. And interest is compounded daily. It may be compounded annually. And that's probably the easiest one to look at. And your book gives the example on page 326 of having $1,000 at 5% interest. What do you have a year from now if it's compounded annually? Well, you have $1,050. If you look at, say, if I have $1,000 today at 5% interest annually, what do I have 5 years from now? Well, it's not that simple. You have to calculate. In this example, that 1 year at the end of 1 year we have $1,050. Well, then we're going to take that $1,050, invest that at 5% interest, and so that leads us to the next. It's more than simply looking at it on an annual basis. I can't do the math in my head right now, but you get my point. Is that the money that you make this year, we're reinvesting, and that's the way you build money in your savings accounts, in your retirement accounts. It's not on that initial investment necessarily, but it does keep compounding as it grows. Your book uses the terms FV, future value of the dollar, and then PV is the present value. And so R is the interest rate. So you can look at the equations there, and if you're good at math and want to play around with them, do so. There's some questions at the end of this chapter that you might want to mess around with. There's one question on the test that will have to do with compounding. I've taken some of the other questions out just because they're really too complicated, more complicated than I am getting into with you and that I feel comfortable dealing with. So I'm going to be changing that up just a little bit. So compounding, what is the future value of the dollar? And that's what we are looking at when we're talking about that. And that's one of the concepts of the time value of money. And as your book explains, when we look at these things, it helps us to determine, even within our impact on our personal, our business, and public financing, as far as discounting and that sort of thing. It helps us determine that time value of money. It's a accounting concept. So we talked about compounding, and again, I would encourage you to look at those. And as it goes through the 5th year, it does do the equation for that on page 326 and 327, where it takes our $1,000. It takes our $1,000, and at the end of 5 years, you're going to have $1,276, according to the chart on page 327. So it's not just a simple $50 a year that you're getting for that interest. The interest that you earn goes up every year. Discounting is another concept that has to do with the time value of money. It adjusts the sums to be received in the future to their present value equivalents. So if somebody says, I'm going to give you, $10,000 3 years from now, what is that worth to me today? And it's basically you're backing out the interest earned. And again, that formula is there in your book. And so if you want to look at that, if we take that same $1,000, if it's received at the end of 1 year, and the interest rate that could be earned on that is 5%, then what is it worth to me today? So according to the formula for present value, it's $952.38. So that is the concept of discounting. There's also a chart at the bottom of page 329 that looks at Project A and Project B. And this is where I really have to get into this to really understand some of these concepts as it relates to choosing, as we apply it to capital budgeting, and which is going to be the most feasible and which is going to be the best. Then there's a whole special case of annuities, using an annuity formula. And I think I put some information about that on the course site as well. Again, I'm not going to get into all of that. A lot of this is what I would consider actuarial type information, which, when we think about what we do, we provide services. We don't make money. So there's some information about annuity formulas on the course site as well. So I'm going to leave that. I'm just going to leave that as it is. I want you to be aware of those concepts when it comes to capital budgeting. I think that at a future date, like I say, I've put some videos up. I've put some information from the accounting textbook about those concepts. I would encourage you to look at that because it is important. I don't want to discount, no pun intended, the information as being important being not important. It's just that I don't. The only help that I can give you is from a private industry standpoint. That's the only consult I have here to help explain that. And so hopefully, just to gather a little bit of information about the concepts, certainly you can feel free to explore some more on your own as we go through this process. And the next concept that the book discusses is cost-benefit analysis. And again, this is, we talked a little bit about this. Those of you that have had the community risk reduction course, we've talked about this. And again, when we look at this, we're looking at it from a different standpoint than a marketing company or any kind of private industry, in that we're looking at services. We're looking at it from a social aspect, and our cost benefit really affects lives. And that's where, to me, this is a difficult concept to grasp and understand, because how do you value that? Well, people have put a value on that. Some people have said, when we look at cost benefit, some people have, trying to see if I'm getting ahead. Some people have looked at, like, well, how much insurance do you have on your life? Well, some people think a lot of their lives, but it's overinflated. That's probably not a good judge, in that it's not just the insurance for our lives, but we're doing this for, say, for our families. It's not how much we think of ourselves, but how much we value our families. And then there's they've developed formulas for determining the cost benefit of a life or of these services. So how you arrive at that, again, look at this information. There's 5 different elements in the cost benefit process or cost benefit analysis. The first is to categorize the project objectives, estimate the impact on those objectives, estimate the cost, then discounting cost and benefit flows at appropriate discount rates, and then summarizing the findings in a fashion that allows people to make decisions. So cost benefit analysis is not a judgment. It is a mathematical process. And again, I could not find any materials applicable in the accounting textbook, because it's very cut and dry in business, and it's not so cut and dry when we are talking about social services. Remember, in some of the test questions from the questions from chapter 2 that you responded to, where it asked questions about how to present information, and they were pretty obvious in that we need hard data, instead of just it's the right thing to do, or people are upset, and leave it at that. They want data. They want information. And that's what cost benefit analysis provides. And so this is just one more way of justifying our project by showing this cost benefit analysis. And many times when we look at the project objectives, when we are talking here, it's not, your book gives this example of a town that's contemplating a newspaper recycling project. They're going to refit some of the garbage truck with a rack to collect bundles of paper. And so they've gone through this, but the bigger question that you have to ask yourself when we're looking at the project objectives, do people want to recycle? That's a bigger question. And it's not one that we can answer by using numbers. Well, you can answer it by using numbers, but it needs to be before. Do we need to do some research? Do we need to do a survey of the community to say, hey, can we recycle? And that, to me, that will help. Do you want to recycle? Will you recycle? And so then they talk about in this chart about what it costs, and then what the revenue is going to be from that. So that's one way. This is how you start, is looking at project objectives. But don't forget that, do people want more parks in their community? I don't know. You have to ask them before we start telling them this is what, doing the cost benefit or looking at what we want, is this something that the community is willing to support? Benefit estimation and valuation, we have to, this is one definition: increase or gains net of associated or induced cost in the values of goods and services which result from conditions with the project as compared to conditions without the project. So if we don't have it, this is what exists. If we do have it, this is what exists. And so that is where we began to look at, I guess it's a comparison of if we don't do this, this is what we're going to have. If we do this project, this is what we're going to have. So sometimes you have to look at, when we're doing this, the benefits. What is the size of this project? Is it, can we do some research ahead of time? Can we do a controlled sample to estimate the probable effects before we go full out into this? That, again, that's hard data, that's information that we can document. If there's a way to do recycling, taking our recycling example, can we just see if the community is going to recycle in a particular neighborhood before we go to the cost of refitting this truck, and pick up newspapers in a pickup truck or something like that. So sometimes you can do this and sometimes you can't. When we're talking about social physical engineering, those kinds of aspects of programs, you may not be able to do that. So we have to look at, when we look at the project's impact, then we have to look at the worth of the benefits. Again, this goes back to the cost benefit in the community of what's the community willing to pay for this particular benefit? Do those costs outweigh what the community, what the community perceives the benefits to be? It's money values are usually used, but it's not. But just so we're comparing apples and apples. It's a common yardstick, as the book calls it, to use dollar amounts. So however you can value that. And it's really hard because sometimes we're not comparing apples and apples. We're comparing apples and oranges and pineapples. So then once we have done our valuation, and your book does give a good example on page 336 about the demand for a park. And I think it's well suited when we talk about what we can pay for this service or what people are willing to pay. So once we've looked at the benefits, then we have to look at the cost and how we're going to estimate these costs. And sometimes that's easier because that's hard dollars, hard numbers. But again, we have to look at what the community sees as that opportunity. There's a gray box on page 338 in your book, a sidebar, about measuring the value of non-market goods. And that's a good source to help us kind of understand how we can put a value on things that don't necessarily have a monetary value. And then next, in this process of cost benefit, select a discount rate. And there's formulas for that, what discount rate to use. You can use various ones. Of course, it's kind of easy to look at the cost of the borrowed money. If we're going to borrow money, that's pretty easy. To use that rate, it's an interest rate that must be paid by the borrower. And then we get into some formulas as we're looking at this on page 341. We began to look at some of these formulas where at our rate of return on the displaced resources, the return on investment, that's always an important concept that we have to look at when we're talking about budgeting. And then the decision criteria, and there's a fancy looking equation on page 342. And it was when I realized I was kind of over my head a little bit. It's been a long time since I took college algebra. Some of you are fresher at it than I am. But there is a decision criteria, and it's a formula that uses numbers to create our cost benefit for a particular project. It uses the benefit cost ratio, which is the present value of benefits divided by the present value of the cost. That I get. And then there's a net present value, which is the present value of benefits less the present value of the cost. So in this formula, B equals the project benefits, C equals the cost, R is the discount rate, T is the life of the project, and then a capital T is the life of the project. Oh, the small t is the year in the life of the project. The capital T is the life of the project. So if you've got 10 years for the project, that's the capital T. The small t is one of those years. So there's your formulas. I'll let you play with those. Again, there are some questions at the back of the book that are in at the back of the section at the end of the chapter that you can look at to use and look at. We're not going to get into those right now. So And then your book mentions the some other measures that can be mentioned, the payback period and the internal rate of return. So read that. They give you some examples there, but some of the things that I wanted to get to is this special problems of cost-benefit analysis when we're talking about the public sector. And we mentioned some of those. Multiple objectives is a problem. We may have, within our government, we have different objectives as far as we want the people to travel safe. We want the people to have fun. We want the people to live and work safe. We want them to have clean water. So some of those objectives are conflicting, and normal cost benefit analysis doesn't really look at that, at the foregone opportunities. That's my term. The other thing that cost benefit analysis doesn't look at is who is getting the benefit. Is it the benefit equal for all? Is there one particular segment of the community that needs this more so than others? Think about your social services. They need it more than others. Is there one section of the community that needs the services more than the other? So is there going to be equal distribution? Is it randomly distributed? How are those things going to be measured? And then another problem, when we look at multiple projects, but also, valuing projects that save lives. And this, to me, in case you can't tell, is one of my biggest issues with budgeting, with cost benefit analysis, is how you determine that. And this is where they talked about the insurance. It's called a value of a statistical life is the term that's used, that gives us an estimate of how much the public is willing to spend to reduce a risk to save one life. And go back to that community risk reduction course. We talked about this. We didn't really talk about it in terms of dollars. We did, but not this specific. We certainly did not give it a name, but the value of a statistical life. So how do we determine that? As it said, we talked about the average life insurance. We talked about the human capital or earning loss method views the human as a machine and their earning potential. And again, this is kind of that actuarial thing that you can get into. The third technique, a willingness to pay, assesses what people are willing to pay to reduce risk to life. And that, again, is such a, to me, it could be a real controversial topic because it goes back to all those things we talked about in community risk reduction of people realizing that they are at risk and that they can do something to reduce the risk. So, again, these things are very much related. Now, and I put a very short video on the course site. I think it's a little bit jaded in one direction, but it does explain this process or the concept of the value of a statistical life. Different agencies use different formulas. That's kind of the interesting part to me, and your book mentions that. All agencies don't use the same value. EPA, the Environmental Protection Agency, uses one different one than the Food and Drug Administration and the Department of Transportation. So again, it's I guess it's a crapshoot of who uses what or how do we value life. So those are some of the problems when we run into with cost benefit analysis. Even though we can put a number to it, it's still very subjective, and it all goes back to the community, what the community is willing to pay. So we've talked a lot about capital expenditures. We know that they are big ticket items. We know that they cost a lot of money, that that they can tax the budget. We know that there's many communities have two separate budgets, and there's a reason for that. We know that even though there may be two separate budgets, they're tied together because if you're going to create a new project in your capital expenditures, you have to have operating expenses for that project in your operating budget. We've talked about the time value of money, kind of briefly, but the concepts of compounding and discounting. And there's information, as I said, on the course site for that. And then we talked about cost-benefit analysis and that there is an exacting formula that goes along with that, whether you agree with it or not. And I think that's maybe my own bias or kind of gives me a little bit of heartburn to think that we can take a mathematical formula and apply it to a life. I don't really see it that way, but some people do, and that's okay. Again, I know that this has been kind of a brief overview. I encourage you to read those extra materials, look at those, play around with some of the questions in the back of the book or the back of the chapter, practice those. Let me know if you have any questions. If I can't answer the question, I will find somebody that can. And again, I apologize for the kind of cursory review of this information. Hopefully, the next time I teach this class, I'll be a much better budget preparer. Thanks so much for your attention, and I hope you have a great day.